Welcome back to Everyday Economics, a podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of 501c3 nonprofit Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our great podcasts at americastalking.com. And joining me, as always, is Dr. Orphe Divounguy. He's a PhD economist. Dr. O, everyone is still talking about Silicon Valley Bank and how in the world could the 16th largest bank in America be solvent one day? You know, the great CNBC stock picker Jim Cramer's darling the previous month, and today be basically a footnote in history. Gone, wiped out. Seemed to happen very, very quickly. What happened, Dr. O?
Yeah, I mean, I heard this question over all throughout the weekend. SVB went from America's 16th largest bank to no more. And in order to understand why, you have to understand basic bank math. And basically, let's do that. Let's break that down for our listeners. Banks take deposit and use them to make loans. So your deposits are not the bank's assets. They're the bank's liabilities, right? The bank actually has to take those deposits and invest them. They have to go out and make long-term loans at higher rates than they pay for deposits, right? In order to generate positive net interest margin, they got to make a profit, right? And so that, if you ever wondered why your savings account pays so little, and yet the interest rate on loans and credit cards is so high, then that's why.
And so what was it specifically that SVB did wrong? Of course, last Wednesday, they announced that they had an after-tax loss for 2022 of $1.8 billion. So they clearly were not making wise investments with their depositors' money. But how do you get it that wrong? I mean, that is a massive miss, right?
I think what happened is they took a bet on the Fed not raising rates as fast and as much as it did. I mean, remember, we went almost 5 percentage points in 1 year. That is unheard of, not seen since the 70s. And so when the Fed raised interest rates, the value of their assets, because what they had done is they had bought these long-term treasuries at really, really low interest rates, right? And so when yields went up, the value of their assets went down. And so they had not hedged properly against the possibility of this happening. And so that's kind of what happened. And so when they started reporting these losses, a lot of people started to get nervous. And the last thing you want is your depositors to panic. If you're a bank, that's the last thing you want. Because once your depositors panic, you get what's called a bank run. Everybody runs to the bank to get their cash out. And that's exactly what happened to SVB. And there's another bank in New York, right? New York Signature Bank was the other one. And since then, what we're seeing now is a lot of people moving their assets, trying to move as much of their cash as possible out of these smaller regional banks into the too big to fail mega banks, the JP Morgans of the world. And so that's what's going on. But look, how does this really affect the economy? It's heightened uncertainty. It's this fear that you could be losing it all that's going to cause economic actors to pull back on spending and investing and hiring and all those things. And so that's why this is actually a disinflationary event. We saw the markets respond with yields falling, right? People are now hiding their money. They're saving as much as possible. That's how this is affecting the economy right now.
So in looking at the numbers, just to kind of give people a little bit of color on this, SVB, Silicon Valley Bank, had $209 billion in assets. Okay. Only $175.4 billion in deposits. So it's not as if, the bank was just like
liabilities. That's right.
Right.
They were in good shape.
But that's the question I want to ask. Is that normal? We wanted to talk about bank math on this. In this space, is that normal? And was it only because of the run on the bank? Peter Thiel, who's a fascinating guy. I just got done reading Blake Masters' book, 0 to 1, it's got a lot of Peter Thiel thinking in it. And it's a smart, sharp book. It's been out for a few years, but I just had a chance to start to read it. So they're $25 billion short. Peter Thiel takes out whatever it was that he took out, and it kind of it started the stampede. But what is normal? What does a normal bank's balance sheet look like with regard to assets, versus the deposit number?
This is totally normal. Again, the problem is that when you invest in long-term debt, you don't have that liquidity, right? You need that. If a depositor shows up at the front door, but I took all of my deposits, all of those, and I invested them into assets that don't pay for, 5, 6, 7, 8 years, 10 years, right? I just don't have it available. And so part of the rescue package, we heard about a rescue package over the weekend, is the Fed making that cash available to banks and taking some of those assets and saying, look, we're going to honor those deposits, even though the cash isn't there. Making that liquidity available to banks is going to be crucial to avoid further bank runs.
Let's call it good here for Orphe Divounguy. It's been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.